Thank you for joining us for our webinar today, Top 5 Things You Need to Know as a New Vet Practice Owner. Before we get started, I wanted to mention that there's a chat feature for this webinar, and you can ask your questions at any time during the presentation. The chat button is at the bottom of the PowerPoint as you hover over it. We will answer all the questions at the end of the webinar during the Q&A portion, but feel free to ask questions via chat as you think of them. Our presenters today are Matt Vanderloo and Justin Chesbrough. Matt and Justin are both CPAs and principals with SVA's Veterinary Services Group. They provide advisory, accounting, and tax services to veterinarians and their businesses. Both Matt and Justin have experience with startup practices and providing vets the financial support they need to grow their practices. And with that, I will hand it over to Matt to get us started today.
Thank you. We're really excited for everybody who's called in today to talk to you and have this opportunity to connect. We're going to talk about the top 5 things that we really think you need to know as a new vet practice owner. And we're really excited to share that information with you. Here at SVA, we've got a group of professionals who work with vet practices and really understand the ins and outs of the veterinary medicine industry. Work with vets on not only the basic tax and accounting things that need to happen for every practice, but work at a higher level with groups to consulting and advising those practices on ways to grow their practice, what their practice might be worth, how to divvy up the profit in a practice, buying a practice, selling a practice, starting a practice, build out costs, leasing costs, acquiring a space to work in. We work with practices on almost everything that needs to be done within a practice that can help you in any way you need. We really strive to deliver measurable results for our clients and for our vet practices as well, coming up with those best practices in practices, helping practices maximize their profitability, and then working with practices to figure out what their goals are and aligning their business goals and their personal goals to achieve those measurable results. So today we're going to cover those great top 5 things that we think you need to know as a new practice owner. We were so excited when we were coming up with this presentation that we couldn't limit ourselves to just 5, so we actually have 6 we came up with that we're going to throw in front of you today as well. So we're going to talk a little bit about entity structure and how you might want to structure your new practice. Talk a little bit about the accounting system and internal controls, financial statement presentation, some really important relatively new tax deductions that you want to keep front of mind as you're thinking about your practice. Talk a little about retirement plans and how that can be a big benefit to you as a new owner. And finally, talk a little bit about expenses that are going to be deductible in your practice that you might not be thinking about, and we want to make sure you're not missing. We're going to cover everything at a really high level, not go too deep into any one of these, but we are going to have some time at the end for questions, so please, if you do come up with any questions, send those in to us. So first up, entity structure. Justin, what's important for our new practice owners to know about how to structure their practice?
Yeah, thanks, Matt. So we put this number 1 because this is really an item that does require thought up front, and we do want you to consult with your advisors when you're making this determination. So there's a couple aspects here. We want to hit really on all the items we're going to discuss today at a really high level and give you some things to think about and some flags to kind of plant in your mind to say, oh yeah, I really need to focus in on this area. So with entity structure, there's a legal aspect of, since everyone that is listening here will be a practicing veterinarian, you want to isolate your individual liability from the liability of your practice. So how you do that, you set up an entity. So we have some options here. So the first that we have listed is an LLC. So this is a limited liability company. That's a legal determination that can, again, limit the liability for yourself. That is not in and of itself a separate tax selection. So bullet point number 2 is talking about, as a single owner, you could be a LLC and be a sole proprietor, which means you are not having a separate tax return requirement, and you are simply reporting your income and expenses on your individual tax return on a special schedule known as Schedule C. The nice thing with that is it does limit an additional tax return and can have some savings that way as far as you don't have a separate return. Another option is you could have an LLC and you could make an S corporation tax election so that you're taxed as an S corporation. We're going to talk a little bit more specifically on these on the next page. And what we see with when you have multiple owners, if you're nothing, you're by default a partnership, but then we also have many multi-owner groups that will also potentially incorporate, and they could be a C corporation, but they could also be an S corporation. So the S corporation and partnership that we have listed here are flow-through entities, and there's certainly some unique tax situations with them. What these we're going to talk about in particular with the qualified business income deduction later on. So all of these entities we have listed here, the LLC, the single owner, and the multiple owners, S-Corp partnership, are ones that are going to be available for this flow-through QBI deduction we're going to talk about later. The one thing not mentioned on this page that I do want to point out is there still is a C corporation, which is what most people think about when they think of a corporation. It's its own entity. It's like its own person. It's a separate entity. But there are separate tax rates for that C corporation as opposed to the individual. For these other entities, you're all paying tax at the individual level. C Corp has its own separate tax. And then any residual profit is paid to the individual. Bottom line is the entities that we see working best for most vets is either this sole proprietor, a single member LLC with some liability protection, and then potentially an S corporation or partnership for multi-member groups. Specifically with the S corporations, it's similar to a partnership, but what's the difference? So for an LLC, the owner and the owners can take payroll checks, and then, this is for an S corporation, different than an LLC. The owner and owners take payroll checks and pay their taxes in through withholding as opposed to quarterly estimates. So estimates are not needed for an S corporation. A benefit is that any residual profit after paying reasonable compensation is not subject to payroll taxes. So for an LLC, all of the profit is deemed as earned. You're not taking wages, you're just simply reporting the income. It's all subject to self-employment tax, i.e. payroll taxes. For an S corporation, there can be a benefit of not paying payroll taxes. Other things to think about, so the last bullet point here is, so the entity that you choose from the get-go will have different tax implications to the sale of that entity. So while a new vet may not be thinking down the road, you still want to be informed and have an educated conversation on the tax impacts ultimately when you do sell. Another aspect that we want to bring up is if you do own a building, if you have a practice and you own the real estate, highly recommend a separate entity to own the building. And that is almost exclusively in an LLC form. A S corporation election, we would not want to do that for a building entity. And we have seen practices that they've been set up and they've owned both the real estate and the practice in the same entity. We don't recommend that. There's a liability aspect, but there's also some really important issues with debt and basis, and in particular distributing property out of these entities where the LLC provides a lot more flexibility for owning real estate. So we hit at a couple of high-level items with your entity setup. Now we want to talk about, now that you've set up your entity, what are going to be some of those accounting systems and internal controls you have in place?
Really good question, and a really important thing to think about as a new owner. So I think the first thing I want to stress here as a new practice owner that there's a lot of different potential accounting systems out there that you could be using, and you've probably heard of a bunch of them. QuickBooks potentially, Peachtree, and there's a multitude of other ones. And really more important than the specific system you're using is that you're making sure you're getting that system set up from the get-go. And what I mean there is that all these different systems are going to require you to set up some broad categories that you want to capture your expenses in. Staff salaries, drugs and supplies, things like that. And it's most important to get those set up correctly so that you've got good historical information from month to month and year to year about where the money that comes into your practice is coming from and where it's being spent. With all the different options you're going to have to look at, you're going to find some that are cloud-based and some that are not. And there's advantages and disadvantages to each depending on whether you're going to want to be able to look at your information at any moment in time and wherever you are, or if you're only going to want to look at your accounting information when you're sitting in your office at the practice. So you'll want to consider that. The other important consideration to remember is when you're thinking about cloud-based or not cloud-based is you're going to want to find a way that's probably pretty easy to transfer that information to your CPA, bookkeeper, accountant on a regular basis. You know, at least annually, you're going to need to probably work with somebody else to help you with the tax return for the practice. But really, I think the other key here, that last bullet point, is you're going to want to review your statements regularly from whatever your accounting system is, and look at those alongside reports from your vet software that gives you information on your patients and what kind of procedures you're doing. And I think, in my mind, ideally, review those with somebody who works with vet practices and can help you interpret all the information you're getting there to tell you how the practice is doing and areas you might want to think about looking at to get a better understanding of how you're spending your money, or ways you might be able to grow and improve the practice. And then ultimately, you're also going to want to consider the easy use of the system. You know, in most practices, it's either one of the owner veterinarians or some sort of office manager, practice manager who's using the accounting system to record receipts and pay bills. So you're going to want a system that that person is comfortable using, and nothing that's so complex that they don't feel comfortable getting into it and actually doing transactions for the practice. The other big piece that goes along with that accounting system is you're going to want to think about some internal controls and what are you doing in the practice to help make sure that nobody's trying to take any money out of the practice in any way that they're not supposed to. And it can be really difficult for something to do these and set up good internal controls in a vet practice, because depending on the size of the practice, there might just not be very many people there. One of the keys usually for good internal controls is being able to separate duties and not have the same person doing all the steps that are included with the process. So for example, when we think about cash coming into the practice, somebody's getting that check, getting that cash, somebody's posting it to your customer system, your vet software to record that payment, and then somebody's depositing that money at the bank. Ideally, we'd have a different person doing each of those three steps and not one person doing it all. But in some practices, you might not have enough people to do all that. So you're going to have to think a little bit creatively about who you want doing what. One of the things we strongly encourage is you shouldn't have a bank stamp, a signature stamp to sign your checks. Take the time to sign those by hand so that somebody doesn't have easy access to being able to sign a bunch of stamps, or sign a bunch of checks for you with that stamp. You might want to think about background checks for your employees so that you really know who you're hiring and where they're coming from. And then you really want to watch for any big changes in your employees. The employee that shows up with a brand new car, a brand new Tesla, a brand new $100,000 car in the parking lot on their $10 an hour salary might indicate that there's something a little shady going on. Might be that they won the lottery or inherited a bunch of money, or it could be some other less pleasant reasons where they have all the cash to do that. So you want to watch for those changes in your employees and any changes in your statements. And there's some things other things you can do here. There might be steps in some process that you want to outsource and have your outside bookkeeper, CPA, accountant take over for you as a second check on some things. Another big area that isn't in a bullet point here, but that you really want to consider is watching your credit card statements and all the purchases that are going through on the credit card. More and more practices are using credit cards to pay for a lot of the stuff that they need to buy. And it might be that the office manager, practice manager, a vet tech has access to that to buy supplies. You want to make sure you know everything that's coming on that credit card statement so that it's all stuff for the practice and nobody's personal expenses are running through there. The next big thing that really goes hand in hand with the accounting system is, as you're setting up that new practice, you really want to think about the financial statements that you're going to generate on a regular basis and what kind of presentation you're using there and how you're grouping information. So the pretty typical setup we see with practices we work with, and the general direction we try and get people to go, is to separate everything on the financial statement into three big categories. Typically, first we'll have a big section for the revenue coming into the practice, and then a big section for your overhead expenses, and then the last section for compensation available to the vets in the practice, and then how that compensation is being paid out in salary to the vets, benefits to the vets, or any residual income in that practice. So it's really good to separate out these three areas and then be able to track them over time. So in that revenue section, maybe you want to have 4 or 5 line items that kind of capture the major areas that are generating revenue in your practice, maybe a surgical line, a drugs and supplies line, an anesthesia line, so that you can track over time how much revenue you're generating from surgery services. And same thing with the overhead expenses. There's going to be a bunch of categories there that you can track over time and monitor that information over time. So it's really important to get this set up right from the get-go so that you can start getting that historical information captured in a way that's going to be good for you use going forward. Our next big topic here, number 4, some important tax deductions that are going to be available to you in a practice, and some relatively new ones. Justin, what are some of the big relatively new deductions we should look for?
Yeah, so the biggest one is what's called qualified business income deduction. So this is one of the biggest changes with the Tax Cuts and Jobs Act that we had. So that started for the prior year. So for 2018 tax returns, this is the first year this was passed with. There was a whole lot of confusion with Congress. The law got passed late. There's proposed regulations that comes out by the IRS. There's final regulations that come out. So I'm sure there's a lot of misinformation out there. So what I want to do is just at a really high level give people an idea of what this deduction relates to, what it means, because it has been one of the biggest changes and potential deductions that we do see for some of our vet clients. So it's got a couple different names. QBID for the qualified business income deduction. It is technically, it's a Section 199A deduction. So in the Internal Revenues Tax Code, it's under Section 199A for those of you who really want to just dive in and do some fun reading. What is it? It's a 20% deduction from flow-through income. So as we talked about the entities that you could be, it's basically any entity that is not a true C corporation. So that includes corporations that have made the S election. It includes partnerships, and it includes sole proprietorships or folks that are filing on their individual tax return Schedule C. This could be for the practice. This could also be for the rental property. At a high level, it's maximum deduction of 20%. Then there is a deduction limited to, as your income grows, there's a deduction that's limited based on wages and the amount of capital or fixed assets you have in here. An important thing to note is that deduction phase out for service businesses. So we're going to kind of go through on the next couple slides really what each of these means a little bit. I will say that there are certainly some planning opportunities that we're going to see based on the wage limitation as far as depending on your entity and how you pay yourself, you can coordinate and plan for the amount of wages you pay that can impact this deduction. So it's certainly not something that you just want to do, at the end of the year and say, hey, what was my deduction? But now that, 2019 is done, it's maybe, hey, the question would be to ask is, am I getting this deduction? And if so, do I have the ability to tweak some items and potentially raise this deduction? The point about being a specified service, trade, or business, so a service business, this is anything in the field of health. The IRS came out with more clarification later on saying that veterinarians are included in this definition of health. So what does this mean? That means any service business that includes health, includes law, it includes accounting, so we're included in this as well. Any of these businesses listed here, the deduction can be greatly limited based on as your income goes up. So for someone that's an architect or engineer that were originally on the proposed regs and got cleaned off the plate here, they can get this deduction regardless of their individual income, that full 20 or the 20% deduction, where service businesses have to do many more calculations to determine what their potential business is, and it's limited greater based on as their income grows. I have another chart here to kind of summarize this, and this does get complicated, but it's certainly worth, and I do want to try to work through this a little bit. So we have three columns here. So the first one is your taxable income before any potential deduction, and this is going to show that as your income goes up, and then in the second column, if you're a service business or not, how this ultimately in the far right column is limited. So if you are married filing joint, which is what the MFJ stands for, and you have income of less than approximately $320,000, and you have flow-through business income, you are eligible for this deduction, and then following the chart to the right, no limitations apply. So this is where we see then, as your income grows for the next $100,000, if you're a service business, this deduction starts to phase out based on the wages and capital. Don't want to get too complicated into that impact. What it means is if your joint income is at $420,000 and you are a service business, any flow-through income, you are actually completely phased out. You get no deduction if you're a service business, and this is where, a friend that would be an architect or engineer, even if they're in that income situation, they have to do some calculations to limit it, but they are going to still get this deduction. While if you're a vet and you're making this level of income and you have flow-through, you have no deduction. So it's still pretty generous as far as going up to $420,000 of income, married filing joint, but unfortunately, a lot of the healthcare service businesses, apparently our lobbyists aren't very good and could not get us into this full deduction. So there are complicated calculations, but I just wanted to address at a high level what this 20% deduction relates to, and because it really has been the biggest tax savings we've seen out of that Tax Cuts and Jobs Act. We're going to go through one more big deduction that was not specifically from the Tax Cuts and Jobs Act as far as any limitation, but this was a specific Wisconsin law that was passed after the fact due to limitations implied by the Tax Cuts and Jobs Act. So this also relates to flow-through entities. So again, S-corps, partnerships, LLCs. This is tax that you can elect. So normally for all these entities, your Wisconsin tax is paid at the individual level. And Wisconsin tax rates for individuals is at the bottom 4% and up to 7.65%. So this is all prior to 2018, what's going on. So now we want to go to the next slide and saying, okay, starting in 2018, which was the first year that this Wisconsin law was applicable to, how does this calculation work? So I want to note that for 2018, S corporations could make this election, and they're electing to have the entity pay the tax instead of the individual. The caveat, or one of the things you have to know when you do this calculation, is the corporate Wisconsin tax rate is a flat 7.9%. So it is higher than that top individual rate of 7.65%. So you do need to plan and know what your individual tax is. The benefit here is at the individual level now, for itemized deductions, all income tax and real estate taxes, so state and local taxes, your deduction is capped at $10,000. It's limited, no matter how high that is. This election shifts that tax to the corporate level and is fully deductible against federal income at the entity level. So if you have a flow-through business and your business makes this election, the tax payments that you pay to the state of Wisconsin at 7.9% are fully deductible. So it's a benefit at the top rate is 37%. So you could all of a sudden create a 37% deduction for your state taxes where you were getting zero deduction at the individual level. So this was available for S-corps in 2018. For partnerships, 2019 is the first year that this is available. I just want to point out that I like numbers, maybe a little bit too much, but I also like quick and dirty things. So if you're saying, hey, what could possibly the impact be to me? If you're out there listening and you're in the top tax rate, this election had a benefit of about 2.67% for any flow-through income amount. So you could say, all right, here's my flow-through income. Yeah, I'm in the top tax rate. This is my potential benefit. Flow-through income times 2.67%. And as your income, if you are not in the top tax rate bracket, that percent does go down slightly. But that is, one of those things that you do have to work through this calculation with your advisor and know if this is beneficial to you or not. So those are, two of the biggest tax planning strategies that we've seen in the last year. Another one relates to retirement plans, a great way to put away some money, and Matt's going to talk to you about retirement plans.
Another great thing to think about. The key with retirement plans is there are a variety of different types of plans out there that'll let you put away different dollar amounts for yourself and for the employees, depending on which plan you select. So it's really important to look through your different options, consider your different options, and pick the plan that's going to work best for you and for the practice. And time is really on your side here. The sooner you can make a selection, the sooner you can get a plan put in place and start contributing to it. Even if you're not contributing the maximum amount allowed, even if you're just putting some of what's allowed in, that gives more time for those dollars to grow, tax deferred, or potentially tax-free, depending on the type of plan you pick and the elections you make, and be there and be bigger when it's time for you and you're ready to retire. Plan design is really important here because depending on the type of plan you pick and some of the specific elections and tweaks you make inside that plan, we might be able to get a little bit higher contribution for you while not having to increase the benefit for the employees substantially over what they would normally get in that plan. So we can really, there's some things we can play with inside a retirement plan to help leverage it to really work in favor of the owners of the practice and get more dollars put away for them right away. The other thing to remember is that that retirement plan can be a great way to attract employees to your practice and to retain employees in your practice. A good retirement plan in a practice can be a great way to hold on to those employees and really make them think twice about making a move anywhere else where they might not be getting as nice a benefit or as strong a benefit. So a great thing to consider in your practice. So that brings us to number 6, our bonus idea here. We hit our top 5, but one last one before we jump out here, deductible expenses. Justin, what are some deductible expenses that those new owners might not be thinking about, might be missing out on?
Yeah, and we want to frame this as, again, as you just said, Matt, for new owners. So this is someone that was maybe an employee and now they're an owner. There's more potential deductions or things to think about as an employee. So really, any expenses that relate to the practice or performing of veterinary medicine is a potential business deduction. So that could be continuing education, travel costs, going to travel to meet with an advisor, and cell phone used in the practice, which, let's be honest, everyone's cell phone is a big part of their business now. It could be a computer that you have at home. If you're doing your books or you're doing charting at home, you could have a computer, dues, licenses, memberships, anything that relates to your business. And a big piece of this is a lot of tax preparers wouldn't even ask these in questions for employees in the past, because with the new tax law changes, a lot of these deductions were limited or eliminated based on the new tax law change for an employee. So now for business owners, these are all on the table again. So charitable contributions, and one thing based on the new tax law changes, it may be much more advantageous to have advertising as opposed to charity. So again, if you're giving money to some place in the past that may be charitable, you might ask for some promotional type relationship with your practice so that it's actually advertising or promotion for you. We get a lot of questions on employing children and spouse of the practice. It can certainly be valid, but it just has to be reasonable. They got to be doing some work for you. And then, it's a great way to have either your children or your spouse possibly get a retirement contribution if you have it. There's certainly plenty that can go in there. Again, it's got to be valid. There's a rental income exclusion, and that may be that if you got an up north cabin type thing and you want to have a little company retreat, you could go there for a weekend, have your entity actually pay yourself rent. And if that's really the only rent you would have on your cabin for the year, you rent it less than basically 14 days of the year, and there's a rule where you can actually exclude de minimis rental income, so you could have a deduction on your practice that is fully deductible and then not have to be picked up as income on your individual return. So again, got to do some due diligence to make sure it's accurate, but certainly a valid item. Another big one that we get questions on from our vets is vehicles. What can I deduct there? There's 2 main ways to do this. You can deduct your actual expenses of a vehicle, or you can deduct mileage. The biggest point here is you need to consider business versus personal use. If you are traveling a lot, traveling not including commuting, your vehicle can be a very big deduction for you. A lot of those large trucks with the customized caps for all your equipment certainly can be a valid deduction and can be a great deduction for you. If you got one clinic, you stay in your clinic and all you do is commute, much more difficult to deduct your full vehicle. And then we're looking at the mileage rate, which can still be a nice deduction. Then you're just tracking your business miles and getting reimbursed at the IRS rates. We have here 58 cents for 2019, and the IRS thought that was way too generous, so they knocked it off half a cent for 2020. One thing to point out is entertainment expenses were limited in the tax law change of 2018. What that does not include is there are still some exceptions relative to occasional holiday parties for your company. Even though there may be some entertainment in nature, those occasional items like a holiday party, a holiday event, certainly still deductible. So you do have to, educate, talk to your advisor, get an understanding of what's deductible, what's not, so that you can properly track that and get all the deductions that you're entitled to by our law. So we went through, those are our top 6 items. I know we went through those pretty quick, but again, we just kind of wanted to, get you guys some high-level items that you can have some mental flags to plant and know to come back to that, hey, this is an important item here. So
all right.
With that.
Now it's time for questions. Just wanted to remind everybody out there, if you do have questions, please open your chat box and type them in, and we will be sure to answer. Wanted to start with one that came through during the presentation. One person out there wants to know, how much money can I potentially put away pre-tax?
Great question, and the answer really varies depending on what type of plan, retirement plan you have set up for your practice and how much you want to be able to put away. Kind of the standard retirement plan, a profit sharing plan with the 401k feature, for 2019 you could potentially put $56,000 into the plan, and then if you were over age 50 you could potentially get another $6,000 into the plan, so a total of almost $62,000. Those limits went up just a little bit for 2020, and for 2020 it's $57,000 plus the $6,500 catch-up if you're over age 50, so $73,500. So you can potentially put in that much with just kind of a standard 401k plan that a lot of people have heard about. There are some other more unique, more unusual plans out there, cash balance defined benefit plans, cash balance pension plans that would allow you to put a lot more than that in if you wanted to. And with a plan like that, you could potentially put in more than $100,000 into your retirement plan each year and have those dollars get that deduction on the tax return for the practice. There'd be no tax on those dollars in the current year. At some point in the future, you probably have to pay tax on those dollars when you pull them out of the retirement plan, but it's a great way to save tax right now.
All right. Next question, relating to entities. I heard about SCs. Are those C Corps or S Corps?
Yeah, we get this question a lot of confusion out there on that. So an SC is a service corporation, which is just simply, once you are a corporation, if you provide the bulk of your services are professional services, you are designated as a service corporation, which has its own little unique set of rules. A service corporation can be either a C corporation, an entity that pays tax at the entity level and then can pay out taxable dividends to its owners and pay salary, or an S corporation, a flow through entity. So an SC stands for service corporation. You can be either taxed as a C corporation or an S corporation while you're an SC. So I hope that answers that.
All right, I think it does. So we're over time. So if anybody else has any further questions out there, both Matt and Justin's contact information is on your screen. Feel free to reach out to them at any time and they would be able to help. I want to thank Matt and Justin for this presentation today and everybody for tuning in. I hope you have a wonderful day. Thanks. Bye-bye.
Thank you.